come up on your screen. It was down 10% on Friday. It's down another 4% right now. It's coming up as the top traded stock. That's Power Grid 194. Indices Bank is down 3.5%. We were talking about that earlier. So giving up some of the outperformance, but it's done so much. Hindalco is down about 3.6%, 382. KPIT Tech is down 3%. KPIT Tech did very well last Thursday and Friday. Deepak Nitrite is down 3.25%, 3.33%. Karur Vaisya, again, from mid-July to last week, from 45 to 80, 85, it's giving up some of those gains. NMDC is down 3%. Varun Beverages is down 4.5%. Jindal Steel is down 3%. Cummins India 3%, and so forth. So that's basically what we have. 8:1 declines to advances is the kind of screen that's out there at this point in time. HUL is up 1.34%. So FMCG did well last week. The nifty FMCG index was up, I think, 4%, 4.5% Friday to Friday. Britannia, HUL, or Nestle is up a little bit, just 1/3%. Marico.
Even Prashant, sorry, the palm oil crash, I think, is also helping.
So I mean, that should help, that dire space as well. Marico is another one which is up just a bit, 0.4%. So, just maybe places to hide, but for what it's worth, that space is up 0.5% to 1.5% or so. But this is an overwhelmingly lower kind of screen that we have on our hands right now. Pramod Gubbi is joining us now. He's co-founder at Marcellus Investment Managers. Pramod, great to have you with us here. Thank you very much. So finally, some sheen coming off with, there is a lot happening, right, Pramod, globally. Lots of countries are having their own issues. Currency markets seem to be in a bit of a turmoil, etc. So natural to expect, these kind of days as well, where the market runs up quite a bit, outperforms, and then kind of catches up a little bit as well. Are we in one of those phases, in your opinion?
Yeah. Hi, Prashant. Thanks for having me. Yes, I think it's just a reflection of the uncertainty even on behalf of the policymakers. If you've seen the recent past, the central banks have made sort of confusing statements as far as the market was concerned. And that's reflective of the fact that I don't think anybody knows how much of monetary tightening, how much of rate hikes is actually required to bring down inflation, given that the sources of inflation itself is a bit mixed together, both on the demand and supply side. Supply side is beyond monetary policy's reach. But at the same time, what the Fed and the central banks are trying to achieve is bring the demand down to the level of the current supply curve so that we bring prices in control. And the fact that how much of this demand destruction is required is, I don't think, anybody's guess here. So therefore, it is a world of uncertainty. We don't know when interest rates will stop rising, when inflation will come under check. And markets, tend to swing on either side of the equilibrium at times like this. So therefore, I think we should be prepared for bouts of volatility like this. The market will try and seek certainty, which is elusive, and therefore volatility will be the order of the day. I don't think there are any easy answers to this, which makes it all the more reason I think investors should look at fundamentally strong businesses to play this market. I'm not saying from a short-term perspective, everybody's exposed here, but that's the whole point of equities. Equities is a long-dated asset class, and investors should be in equities with a relatively long-term horizon. And if you can afford that long-term investment horizon, best to be positioned in fundamentally strong businesses, which can take these bouts of volatility much better in this stride and perhaps actually gain from these adversities. As both inflation and higher interest rates affects weaker competitors, companies which can withstand this with stronger balance sheets and stronger pricing power will emerge out stronger with a larger share of the market at the end of the adversity. So this bout of volatility is going to sustain, and all the more reason you need to be looking at fundamentally strong businesses.
Fair point. Pramod, hi, good morning. So, you normally tell us that you don't take large market calls. You focus on bottom-up stock approach. So any fresh ideas that you or your team may have identified, which you might be looking to sort of, or may have already added or looking to add at current prices?
Well, and Anuj, we don't make that many frequent changes. We are in some ways creating portfolios which are prepared for adversities. We look at long history of businesses which have gone through multiple cycles and withstood these adversities and come out stronger. So we're not creating these portfolios expecting a certain market situation. We are prepared because the whole philosophy about is about protecting the downside. And if we indeed manage to sustain these or survive these crises, we'll be able to get the upside as well. Given that there are very few changes that we normally make in the portfolio, the most recent change in our Kings of Capital portfolio has been the addition of ICICI Bank, where we bought it for our clients, and all of us at Marcellus are investors in the same portfolio as well. We reckon there has been a significant change in the risk appetite of the bank. It's been run more conservatively. In any case, the retail aspect, both the liability side and the operating and the technology side of the bank, was pretty strong. Fixing the asset side and the prudence of lending culture means that this bank is set nicely for the next decade or so in terms of market share gain, which is part of the consolidation theme in Indian banking. So that's been the one major change recently. Otherwise, the portfolio remains fairly stable.
To be fair, ICICI Bank has had a very good run, right? It's outperformed the market. It's up 18% this year already. And it has showcased its dominance, at least by way of its earnings. Any other changes that you've made? You said this was the big change, but any other changes to the Kings of Capital portfolio, either in terms of a sector, a big trend, a theme that you like?
So, no, I think this has been the only addition as far as Kings of Capital is concerned. There have been a couple of exits, both from the capital market side, both were plays on financialization of savings. HDFC, AMC, and ICICI Securities, while we think they are fundamentally good companies, we think the industry structure is sort of deteriorating from a competitive intensity, entry of new players, which is reflecting in pricing and yields in both of these businesses. So while market share remains fairly stable, the deterioration of yields and hence the attractiveness of the business from an industry structure standpoint, we exited those. Otherwise, Kings of Capital remains pretty much stable as a portfolio.
Pramod, you own a bunch of chemical names as well, right? What's happening there? Are price, like what we're seeing in many other sectors, are prices coming back in many areas back to pre-COVID kind of levels? I mean, generally, what's the trend overall?
No, I think chemicals, there's a structural tailwind happening in terms of shift in production from China to India, which has been happening even before COVID, actually. I think there'd been a crackdown in emission norms in China. So even prior to COVID, you saw that shift in sourcing from Western buyers in certain aspects. That trend has only got accelerated with COVID, where the supply side challenges meant that Western buyers would look for alternative sources from a supply chain perspective. And on top of that, the emerging geopolitical situation means that's got even more accelerated. So the demand side tailwind is pretty strong for the industry as a whole. Within that, I think there are different types of chemicals. Some are more commoditized, where there's no source of competitive advantage, and hence we tend to stay away from. But there are a few areas where there are competitive advantages, either from the perspective of strong R&D or chemistry skills, or in the form of natural entry barriers, because these are heavily regulated industries. Some of them are harmful, and hence it's very difficult to get into the business because of the regulatory permissions required and so on. So a combination of those is what interests us. We have invested in companies like alkyl amines, Fine Organics, Galaxy Surfactants, Poshak, across our portfolios in small and mid cap. All of us, including myself, are customers or investors in the same portfolio as well. We reckon these demonstrate those characteristics of significant pricing power, significant entry barriers. and we will tend to benefit from this structural tailwind on the demand side. Yes, in the short run, there were headwinds in the form of input cost inflation, but that we see already abating. We're already seeing raw material prices across, whether it's crude or other commodities, already coming off, and that'll begin to show in terms of margins coming back to normal levels for these companies. So the long-term benefit of demand tailwind and the short-term reversion to mean on the margin side should mean that earnings and free cash flow growth should be pretty strong for some of these companies.
Okay, Pramod, do you have any investments in housing finance as a sector? Any stocks here? That's in focus once again after what happened to Canfin Homes, for example.
Yes, we do own Aavas and Home First in our financials portfolios, and we're quite positive on the long-term characteristics of this. Remember, both are not just housing; they're mostly operating in the affordable housing segment. This is where we believe that the competition from banks are naturally equipped with better cost of funds and hence tend to be competitive in the prime mortgages segment. But in the affordable housing segment, where banks still lack capabilities in terms of sort of assessing the risk of the borrower, because these are not typical borrowers with who can be assessed using digital means or data. You need specific risks to assess, specific skills to assess the risks of these borrowers. At the same time, it requires significant focus or distribution reach into specific territories. So there are players like Aavas and Home First, which have built significant capabilities on these two fronts. And we reckon there's a long way, given the nature of housing evolution in this country. There's a long way, particularly in the affordable housing segment, in terms of demand to capitalize on these trends.
Okay, one more space that you like, and I notice is present in your Kings of Capital portfolio, is insurance. You like ICICI Lombard. I don't know if you still have it, but it was a strong set of earnings, that the company has been reporting for the last few quarters. There's a very healthy growth in their premium income. Want to understand from you, is this a structural story, or is it something that you're just bullish on for a specific time period? And what are your thoughts on the sector as a whole?
I mean, we generally take long-term bets here, and ICICI Lombard is no different. We believe there is a macro story in terms of penetration of general insurance across motor, property, health insurance. Penetration levels are still relatively low, so that's the structural tailwind on the demand side. But it's also fairly consolidating industry. You've seen significant M&A, significant exits in terms of players. So there are fewer and fewer players. The competitive intensity is getting better. Yes, there is competition from a couple of fintech players, which we don't think is sustainable as far as pricing is concerned. So to that extent, ICICI Lombard, being one of the oldest private sector general insurers in this country, with a dominant market share, has all the capabilities in terms of being a beneficiary of the consolidation that we are seeing in the sector. So the demand side is quite structural, which is aided by the sort of competitive advantages some of the incumbents have built. And that results in consolidation, which should give disproportionate benefit of the earnings level. But it is a structural story. We're not here in general insurance for the here and now.
Okay, it's a structural story. Got that.